A bank account can hit zero in three very different ways. The first is the version everyone understands. You spent what was there, and the balance simply ran out. The second comes from technical collapse. In October of 2024, the outage at Bank of America caused millions of customers to open their apps and see zero balances for several hours. Their money had not vanished. The system display was broken. The numbers on the screen were false. Then there's the third path. Almost nobody discusses it because it does not explode into headlines. No emergency press release follows. Journalists rarely cover it because there is no dramatic public event to point at. The institution makes a decision, often long before you know anything is wrong, to terminate your relationship with them. There is no warning delivered in time for action. Then, on an ordinary Tuesday morning, just before rent is due, you check your account and see nothing. Not because of a glitch, not because of spending, because the bank closed the account, returned your funds minus whatever fees were deducted, and shut the door. You have been debanked. And in 2026, this is happening to more Americans, more companies, and more organizations than at any previous period since compliance-driven closures became normalized under the Bank Secrecy Act and the anti-money laundering structures that expanded after it. A report published on the 25th of April, 2026, confirmed that banks across America are tightening internal risk systems. Quiet de-risking sweeps are now reaching ordinary account holders, not just commercial clients or industries long considered high risk. What makes this dangerous is the silence. Accounts can disappear with almost no practical warning, leaving people scrambling for access to cash, unable to cover rent, payroll, or basic bills. Analysis released on the 30th of January 2026 confirmed this can happen to virtually anyone. Small businesses may lose access because a bank no longer wishes to support a category of commerce. Consumers face increased closure risk after abrupt changes in transaction behavior. And the Office of the Comptroller of the Currency Review, issued in December 2025, confirmed that all 9 of the largest banks in the United States had engaged in debanking activity, with certain closures tied not to specific misconduct, but to entire business classifications. This is not about temporary display errors. This is about systematic closure decisions driven by algorithms, compliance protocols, and institutional risk calculations that classify certain accounts as no longer fitting the preferred profile. And it is unfolding now, at scale, often against people who broke no rules at all. The numbers reveal why this matters. The April 2026 findings documented broad de-risking campaigns affecting average consumers rather than only obvious high-risk sectors. The December 2025 OCC review found all 9 major American banks had terminated relationships across categories including oil and gas, coal, payday lending, and firearm-related businesses, often citing reputational exposure or negative media perception. Analysis released on the 30th of January 2026 also noted that President Donald Trump filed suit against JP Morgan Chase, alleging politically motivated account closures, while confirming banks retain broad authority to end relationships for compliance or internal risk management reasons. The American Bankers Association documented in 2026 that the pace of these actions has accelerated under increasingly strict anti-money laundering obligations requiring deeper behavioral monitoring of customers. Financial Crimes Enforcement Network guidance reinforces these obligations. When activity raises concern, banks may file suspicious activity reports. Under the Bank Secrecy Act's anti-tip-off provisions, they are legally barred from informing the customer that such a filing exists. This is not fringe speculation. The OCC, the American Bankers Association, major national reporting, the compliance architecture itself, all point to the same conclusion. Banks are closing more accounts than before. Automated systems identify patterns rather than proven violations. Explanations are minimal. Notice is often inadequate. No exact national count exists because neither regulators nor financial institutions are required to publish aggregate debanking figures. But analysts reviewing complaint data submitted to the Consumer Financial Protection Bureau and 2 state banking regulators estimate that millions of accounts each year are impacted through a combination of debanking actions, dormancy closures, and overdraft-triggered termination. 3 mechanisms are producing these zero balance outcomes in 2026. Each has different triggers, each targets different populations, and each demands different defensive action. The first mechanism is the compliance-driven debanking sweep. This was identified across every one of the 9 largest banks reviewed in December 2025 by the OCC. Banks now deploy artificial intelligence-driven transaction surveillance systems that constantly scan behavior for patterns linked to financial crime, regulatory concern, or reputational exposure. When an account is flagged, a compliance review begins. That review may end with closure. Sometimes, no employee ever speaks directly with the customer. A letter arrives, often by standard mail, giving a 30 to 90-day timeline for termination. No explanation is required. In certain cases, closure information is also reported to check systems. the consumer reporting agency many banks consult before approving new accounts. That record can prevent replacement banking access for up to 7 years. The most common triggers documented in 2026 include large unexpected deposits inconsistent with historical patterns, international transfers sent to newly added recipients, clusters of rapid sequential transactions, cash deposits outside established account behavior, business classification exposure tied to high-risk industries, and inactivity, because dormant accounts often receive elevated scrutiny under internal risk scoring models. The second mechanism is overdraft-driven account termination. Reporting released in 2026 documented that prolonged negative balances can quickly trigger closure. Most institutions allow roughly 30 to 60 days before charging off and terminating an overdrawn account. Repeated overdrafts and unpaid fees signal instability. And in a heightened de-risking environment, banks are increasingly unwilling to retain accounts, showing persistent strain. This places the 42 to 45 million Americans living under chronic bill pressure at greatest risk. As previous financial stress analysis documented, these households are the most likely to trigger overdraft events. An unexpected expense arrives before payroll clears. The account drops below zero. A fee posts. That fee deepens the deficit. If the balance remains negative for 30 to 60 days, termination follows. That closure is often reported to check systems, making replacement access difficult at precisely the moment financial pressure is already severe. This is where paycheck-to-paycheck fragility becomes a zero-balance banking crisis. The financially weakest households face the highest probability of entering this sequence. The third mechanism is the dormancy to escheatment pipeline. This process was detailed in Senator Elizabeth Warren's letter sent on the 16th of April 2026 to the National Association of Unclaimed Property Administrators. It follows a protocol first established in 1929, when an account shows no customer-initiated activity for 1 to 5 years. Depending on state law, it is frozen. It is then classified as unclaimed property. Eventually, the funds are transferred to state custody. At that moment, the account balance becomes zero. The money still exists, but it no longer sits where the customer expects to find it. There are only 3 ways a bank account suddenly displays a zero balance. Most people recognize the first immediately. The money is gone because it was spent. The second happens during technical failures. In October of 2024, Bank of America experienced a system outage that showed zero balances to millions of customers for several hours. Their funds were still there. The system display was wrong. But there's a third path to zero, and almost no one talks about it. It creates no breaking headline. It triggers no urgent press conference. It unfolds quietly, behind closed doors, with no visible event for the media to cover. A bank decides to terminate your account before you ever realize a decision has been made. No warning reaches you soon enough to respond. Then, on an ordinary Tuesday morning, you open your banking app to pay rent, and the balance reads zero. This time, it is not a software error. Your money has been returned, reduced by whatever fees the institution deducted, and the account itself has been shut down. You have been debanked. In 2026, this is happening to more Americans, more businesses, and more organizations than at any other point since account closures tied to compliance became standard after the passage of the Bank Secrecy Act and the anti-money laundering frameworks that followed it. Analysis published on April 25, 2026, confirmed that banks are tightening risk controls and conducting large de-risking sweeps that are quietly affecting ordinary customers, not only businesses or traditionally high-risk sectors. Another report, released on January 30, 2026, confirmed something even more unsettling. Debanking can happen to anyone. A small business can lose its bank relationship simply because a bank no longer wants to serve that category of business. An individual consumer can face closure after a sudden change in account activity. A review by the Office of the Comptroller of the Currency in December 2025 found that all 9 of the largest banks in the United States had engaged in debanking activity, with some closures based not on a customer's actions, but on the industry category attached to that customer. This is the story behind those zero balances now appearing across America in 2026. 3 separate mechanisms are creating them. Each one affects a different group of people. Each one has a different trigger, and each one requires a different defense. Because the real danger is not the temporary zero caused by a software glitch. The real danger is a banking system increasingly driven by algorithms, compliance departments, and risk models that quietly decide certain accounts no longer fit the bank's preferred profile. Those decisions are happening right now, at scale, often to people who have done nothing wrong. The size of the problem matters, because scale defines urgency. The April 25th analysis documented that banks are running de-risking programs that affect everyday customers, not only businesses or obviously high-risk industries. The December 2025 OCC review found that all 9 major American banks had engaged in account closures tied to industry categories including oil and gas, coal, payday lending, and firearms-related businesses. with reputation risk and negative media exposure sometimes cited as justification. The January 30th, 2026 report also noted that President Donald Trump filed suit against J.P. Morgan Chase, alleging his accounts had been closed for political reasons. At the same time, banks retain broad legal authority to close accounts under risk management and regulatory compliance policies. The American Bankers Association acknowledged in 2026 that this trend has intensified because anti-money laundering regulations require banks to monitor customer behavior more aggressively, under rules enforced by financial crimes. Enforcement network: banks must file suspicious activity reports whenever a transaction appears concerning. Under the tipping off provisions of the Bank Secrecy Act, the bank is legally forbidden from telling the customer that such a report has been filed. These are not isolated claims. The OCC, the American Bankers Association, National Reporting, the entire compliance infrastructure, all pointing to the same conclusion. More accounts are being closed. Automated systems are flagging patterns instead of proven wrongdoing. Explanations are minimal. Advance notice is often inadequate. No exact national count exists because neither banks nor regulators are required to publish total debanking figures. But analysts studying complaint data from the Consumer Financial Protection Bureau and multiple state banking regulators estimate that millions of accounts are affected each year through a mix of debanking, dormancy closures, and overdraft-related terminations. Now look at the three mechanisms creating these zero balances. The first is the compliance-driven debanking sweep. This is the exact mechanism described in the OCC's December 2025 review across all 9 of the nation's largest banks. Modern banks use automated, AI-driven monitoring systems that continuously scan accounts for patterns linked to financial crime, regulatory exposure, or reputational risk. Once an account is flagged, a compliance review begins. That review can end with closure. Often, no bank employee ever speaks directly with the customer. A letter arrives, usually by mail, giving somewhere between 30 and 90 days before shutdown. No detailed explanation is required. In some cases, the closure is also reported to ChexSystems, the consumer reporting agency used by other banks when deciding whether to open a new account. That report can make opening another bank account difficult for as long as 7 years. The most common triggers in 2026 are now well documented. Large deposits that do not match a customer's normal history, international transfers sent to newly added recipients, rapid sequences of transactions that appear unusual, cash deposits inconsistent with established account behavior, industry-based risk when the customer is tied to a higher-risk business category. Even inactivity can trigger concern, because dormant accounts may be classified by risk models as more dangerous than active ones. The second mechanism is overdraft-driven account termination. The same reporting confirmed that allowing a negative balance to remain unresolved can quickly end in closure. Most banks allow only a short recover. The funds are not truly missing. In most cases, the money still exists. It has simply been transferred into the custody of a state treasury. But getting it back is another battle entirely. First, the owner must realize the transfer happened. Then they must locate the funds inside a state unclaimed property database, submit formal documentation, and wait through the processing period before recovery is approved. At this moment, state governments collectively hold nearly $70 billion in unclaimed property connected to accounts that passed through this exact pipeline. Roughly 1 out of every 7 Americans has money sitting in a state treasury without even knowing it exists. Now consider the historical evidence behind these 3 zero balance mechanisms, because the past explains the human consequences more clearly than any technical regulation ever could. The first case stretches from 2013 through 2017 during the period known as Operation Choke Point. It remains the clearest large-scale example of systematic debanking created through compliance pressure. Under that Justice Department initiative, banks faced pressure to sever relationships with payday lenders, ammunition sellers, and several other industries regulators labeled as high risk for fraud exposure. Thousands of lawful businesses suddenly lost access to banking services at the same time. Many received little warning. Some were never given a meaningful opportunity to address whatever concern triggered the shutdown. For countless companies, replacing those banking relationships became nearly impossible because the same regulatory environment that encouraged the original closures also branded their industries as dangerous. Employees connected to those businesses watched payroll accounts disappear. Owners saw operating accounts terminated overnight. For them, the zero balance threat was not theoretical. And this is not some forgotten story from a distant era. The December 2025 review by the Office of the Comptroller of the Currency, which confirmed that all 9 major banks were engaged in debanking activity, along with executive actions from President Donald Trump aimed at addressing debanking practices, represent the modern institutional response to a problem Operation Choke Point already proved was real, widespread, and destructive to legitimate economic activity. The second historical example involves the dormancy to escapement process affecting families after the death of a relative. Imagine a person passes away without informing anyone about a particular bank account. No transactions occur afterward. No family member knows the account exists. Over time, inactivity causes the account to become dormant. Depending on the state, after 1 to 5 years without customer-initiated activity, the bank freezes the account, reports it as unclaimed property, and eventually transfers the funds into the state treasury. Years later, perhaps 3 or 5 years after the death, a family member uncovers evidence that the account existed. They check the balance and find zero. The money is still there, technically, but now it sits inside a government system requiring proof of family relationship, estate documentation, and verification of the transfer before any claim can be approved. Many families complete the process successfully. Others never do. That enormous pool of approximately $70 billion now held in state treasuries is built from hundreds of thousands of stories exactly like this one. Families already overwhelmed by grief and estate management often reach the point where a forgotten savings account displaying zero simply becomes the final chapter. The third example was experienced by millions of Americans at once during the October 2024 outage involving Bank of America. Customers opened their banking apps and saw zeros across every account. Bill payments suddenly looked impossible. Some feared rent checks would bounce before the problem could be fixed. What made the situation stranger was that the bank's automated telephone system still reported the correct balances while the mobile application displayed nothing. By evening, the issue had been corrected. No funds vanished permanently. Yet the human reaction during those hours revealed how fragile the system can feel. Reporting from Fox Business captured the moment precisely. One customer posted on X that every balance inside the app showed zero, while the automated phone system still confirmed the real amount. Meanwhile, the bank's support account on X directed customers toward automated links for assistance. The Bank of America outage was temporary, a glitch. It ended the same day. But in response to that incident, Thomas Vartanian published an essay in The Hill titled, "The Internet's Worst Zero Day Could Drain All of Our Bank Accounts." His argument reached far beyond a technical outage. For someone living without savings and without a second account at another institution, the practical difference between a temporary app failure, a compliance shutdown, an overdraft termination, or a dormancy transfer barely matters in the immediate moment. The screen says zero. Rent is due today. Bills cannot be paid. Whether the cause is software failure or regulatory closure changes nothing about the immediate consequences. A missed rent payment remains a missed rent payment. Another overdraft still happens. Borrowing money from relatives becomes necessary either way. And that reality leads directly into the protection framework designed to reduce exposure to all three mechanisms. The same defensive principles discussed in the 1929 protocol remain critical now. Maintain a second banking relationship, log into accounts regularly, create periodic transaction activity, and understand the exact triggers capable of activating compliance reviews or dormancy processes. Protection against the first mechanism, the compliance-driven debanking sweep, depends on 4 specific habits. Begin by keeping transaction behavior steady and predictable. Modern AI monitoring systems build behavioral baselines around each customer. The biggest danger comes from activity that sharply deviates from that established pattern. Large, unexpected deposits, fast sequences of transactions, international transfers sent to unfamiliar recipients. These are among the most common triggers capable of launching a compliance review. If an unusual transaction is coming, contact the bank before it happens. A secure message explaining an incoming large deposit or international transfer creates documentation the compliance department can review before escalating concern. Second, keep balances positive and resolve overdrafts immediately. Reporting throughout 2026 has made this point unmistakably clear. Accounts that remain negative too long face a sharply increased risk of closure. The moment an account slips below zero, fixing it becomes the highest financial priority that same day. Third, make sure all contact information remains current. If the bank cannot reach you through the correct address or phone number, critical notices may never arrive. Many closures begin simply because a compliance inquiry letter was mailed to an outdated address and the customer never responded. Fourth, maintain a separate account at another financial institution beyond your primary bank. If the main account becomes frozen or terminated, the secondary account becomes the bridge that keeps your financial life functioning. Structurally, this may be the strongest protection available while also being one of the least expensive to maintain. Protection from the second mechanism, overdraft-driven closure, is more straightforward. Maintain a cushion inside your checking account large enough to absorb minor unexpected expenses. If you also hold a savings account at the same institution, connect it for overdraft protection. That allows automatic transfers from savings whenever a payment exceeds the available checking balance, preventing the account from falling negative. And if an overdraft still occurs, repay both the negative balance and the fee. immediately, ideally the same day, before automated risk systems begin categorizing the account as financially distressed. Protection against the third mechanism, the dormancy to escapement process, requires 2 quarterly habits. Every quarter, log into each bank account, credit union account, savings account, and investment account you own. Then perform at least 1 customer-initiated transaction for every account. Even a simple $1 transfer is enough. The login combined with the transaction creates a documented timestamp of activity that resets the dormancy clock regardless of how state law may have changed since your last review. And finally, search your name inside the unclaimed property database today. Search your spouse's name, search your parents, search deceased relatives as well. Because for millions of Americans, the first sign that the money disappeared was never a warning letter. It was the moment the balance suddenly showed 0. Right now, 1 out of every 7 Americans has unclaimed property sitting inside a state treasury. Most people have no idea it exists. The search costs nothing. Filing a recovery claim costs nothing. The average payout exceeds $1,100. Some recoveries reach 6-figure and even 7-figure amounts. 30 seconds spent searching could uncover thousands of dollars. Taken together, the protective measures discussed so far directly counter every major mechanism capable of creating a 0 balance in a legitimate account. These safeguards are available to every American regardless of income level, banking experience, or credit profile. They require no expensive tools. They can be completed in under 2 hours. And they form the dividing line between households protected from the de-risking sweep, the overdraft spiral, and the dormancy transfer pipeline, and households that discover too late that one of those systems has already activated against them. The danger surrounding 0 balance events in 2026 is not random. It is structural. And the acceleration happening now is the result of 3 separate forces colliding at the same time after years of gradual buildup. The first force is the intensification of AML enforcement. Worldwide anti-money laundering enforcement generated more than $4.3 billion in penalties during 2024. Financial institutions that failed to file suspicious activity reports on transactions, regulators later deemed suspicious, faced enormous fines and regulatory punishment. That reality changed the behavior of the banking industry. When annual enforcement penalties exceed $4.3 billion globally, banks respond by aggressively lowering the threshold for suspicious activity filings and account investigations. If a bank files a suspicious activity report on a legitimate customer, there is effectively no punishment for over-reporting. But if the institution fails to file, and the account is later connected to financial crime, the regulatory consequences can be massive. That imbalance creates a powerful institutional incentive. From the bank's perspective, overflagging and overclosing accounts becomes the financially rational choice, even when innocent customers suffer the consequences. This exact concern appeared in guidance issued during 2025 by Financial Crimes Enforcement Network and the Office of the Comptroller of the Currency. Both agencies specifically reminded banks that suspicious activity reports should not automatically justify shutting down customer accounts when the underlying issue is unrelated to legitimate anti-money laundering concerns. That warning existed for one reason. The overfiling problem had already evolved into an overclosure problem at massive scale. The second structural force is the rapid expansion of AI monitoring systems. Throughout 2024 and 2025, financial institutions poured billions into AI-driven transaction surveillance technology. The reason was simple. Regulatory pressure made human review alone incapable of handling the sheer transaction volume moving through the modern banking system. AI platforms, capable of analyzing billions of transactions in real time against millions of compliance rules, became the technological answer to regulatory demands, impossible for human teams to satisfy manually. But AI systems generate false positives. Ordinary consumer behavior can resemble suspicious activity when stripped of human context. A normal transaction pattern for a struggling household may mathematically resemble the pattern associated with fraud or account misuse. And because the regulatory cost of missing suspicious activity is far greater than the cost of wrongly flagging an innocent account, banks are incentivized to act on alerts rather than clear them. That means false positives continue flowing through the compliance pipeline all the way to account reviews and closures at a speed no human-only compliance department could ever sustain. The scale of deployment in 2026 is enormous. JP Morgan Chase, Bank of America, Citigroup, and Wells Fargo have all publicly disclosed the use of AI and machine learning systems that examine transactions continuously in real time. Even if the false positive percentage remains low, the absolute number of incorrectly flagged accounts becomes staggering when hundreds of millions of transactions move through these systems every single day. The third structural force is economic stress amplification. Earlier analysis in this series documented that 66% of Americans are living paycheck to paycheck. Ironically, The same financially stressed population is also the group most likely to generate the exact transaction behaviors AI monitoring systems classify as suspicious. Not because they are criminals, because financial hardship naturally creates transaction patterns. Compliance systems are trained to detect frequent small withdrawals, rapid account depletion, repeated overdraft sequences, incoming third-party payments from multiple sources, as households juggle several income streams, cash activity that falls outside the digital baseline the monitoring system expects. Every one of those behaviors can be a perfectly normal response to financial pressure. Yet each also resembles behavioral markers associated with account misuse inside AI risk models. That is why the current stagflation environment matters so much. Economic pressure is simultaneously weakening household financial stability while increasing the likelihood that those same households trigger compliance reviews and account closures. The people least capable of surviving a sudden account shutdown are often the same people most likely to be flagged by automated systems. This outcome was not designed intentionally. It emerged from the convergence of three powerful trends happening at the same moment: intensified AML enforcement, mass deployment of AI transaction monitoring, and escalating economic strain. And that convergence explains why the zero balance warning in 2026 should be understood as a structural threat inside the banking environment rather than a temporary anomaly. Now consider what actually happens during the first 48 hours after an account is unexpectedly closed. This is where the recommendation for a secondary account becomes urgent instead of theoretical. The consequences arrive all at once. Any direct deposit scheduled to enter the closed account will usually be returned to the sender if the account no longer exists when processing begins. Imagine a worker paid on a bi-weekly payroll schedule. If the account closes between pay periods, the next paycheck bounces back to the employer instead of reaching the employee. The worker does not get paid. Often they do not even realize the deposit failed until they check the account and discover a zero balance staring back at them. Then, the employer must process the returned payment, issue a replacement paper check, or establish a new direct deposit arrangement linked to another account. That process commonly requires 3 to 5 business days. For those 3 to 5 days, the individual effectively loses access to income. At the same time, every automatic payment tied to the closed account begins failing. Mortgage drafts, rent payments, car insurance, utility bills, any scheduled withdrawal connected to the terminated account bounces immediately after closure. Returned payment penalties appear. Credit reports may record late payments connected to debt obligations. If the missed payment involves a mortgage, the 30-day delinquency clock begins running immediately. For households already trapped in paycheck-to-paycheck living, this is not a minor disruption. The combination of a 3 to 5 day income interruption and multiple failed automatic payments can rapidly transform stage 2 buffer depletion into a stage 3 debt cascade, or push a household from stage 3 directly into stage 4 financial collapse. That is why a secondary account at another institution funded with 30 to 60 days of essential expenses becomes so critical. That reserve account converts the 3 to 5 day disruption from a financial emergency into a manageable inconvenience. Direct deposits can be rerouted to the backup account within one payroll cycle. Automatic payments can be updated to draw from the secondary institution instead. And the 30 to 60 day expense reserve creates the liquidity bridge necessary to avoid missed rent, missed mortgage payments, or canceled insurance coverage during the resolution period. Open the second account before the primary account fails. Because once the balance suddenly reads zero, the protective value of a backup account created afterward is already gone. Stay alert, stay prepared, and treat your banking relationship with the same seriousness as every other critical layer of financial security. Because in the current system, access to your money is no longer something you can afford to take for granted. Thanks for watching. See you in the next one.